to people joining us from US, Canada, and good afternoon to people joining us from UK and UAE. My name is Gaza. I'm your host today, and very warm welcome to our webinar to navigating on Canadian, US, UK, and UAE residential rental properties tax implications. This webinar has brought to you by our team at Legend Fusions. We are thrilled to have 140 people registered to take part and join us today. We are still expecting so much more people to join. So we might wait a couple of more minutes and start it properly. Hope this webinar will be an insightful session and with invaluable takeaways for you all. And we are so glad to have you all here. If you are a snowbird, remote worker, investor, or just recently moved across the border, this session is designed to give you a much clearer understanding on how cross-border investment in residential rental properties impacts your filing and obligations. It's truly a complex area, but getting it right means a real peace of mind. Today, we're joined with the incredible panel of experts. Mr. Jeffrey Ross, our cross-border tax consultant, Ms. Binish, our Canadian tax specialist, and Mr. Faizan, our UK tax expert, and also we have a distinguished guest of the speaker, Mr. Farhan Osman, who is a senior manager group tax at Dahra Group. He has extensive experience in UAE market. And today's session is going to be a bit timely because Legend Fusion has recently expanded its presence in UAE, responding to growing demand for sophisticated tax and advisory services in the region. In the UAE, also Legend Fusion offers a comprehensive range of services, including international tax structuring, corporate and personal tax for entities and also individuals. Also for the people in and out of the UAE, obviously. Cross-border tax compliance services as well as advisory covering movements between my apologies. Covering movements between areas like UK, Canada, US, and EMEA. Other services like VAT and indirect tax advisory, as well as corporate immigration and residence or citizenship planning for I apologize again, for those establishing or expanding operations in UAE. Within this UAE platform, our clients can now access an integrated regionally based team that combines a global tax expertise with local UAE regulatory insights. That's the introduction. So let's just jump right in it. And to kick us off, we have our lead tax advisor from Canada, Ms. Binish Mahmood, with over 10 years of experience in tax, financial management, and accountancy. She truly excels in tax planning and compliance. Hello to Ms. Binish, and can you please walk us through how CRA figures out what qualifies as your principal residence?
Thank you so much, Khazale, for that too much lovely intro. And I'm so happy and excited to be here. And a big hello to everyone joining us. Yeah, thank you so much. The question is pretty common. A lot of people they get confused about the principal residence rules. In simple terms, the CRA considers a property your principal residence if it checks a few boxes. First, it has to be a housing unit, like a house, condo, cottage, an apartment, or even a houseboat. I wish I had one. And then you own it. Secondly, you have to have the ownership. It could be full ownership or jointly with someone else. Then you or your spouse, partner, or children, they have lived in it at some point during the year. and you don't have to live it throughout the year, but at some point during the year. And last of all, you have designated it as your principal residence while you had reported it in your tax return. So there then comes the question about land. The land included is up to, you can say, half a hectare, about 1.24 acres, unless you can show a larger area was necessary. Sometimes there is a zoning requirement, but that's pretty rare. And also, you can also designate one property per year. It's not that you can have multiple properties and you can declare all of them as your principal residence. That's not the case. It has to be one property. And the good part is, if that particular property qualifies for all the years you've owned it, you typically do not pay capital gains tax when you sell them at all. So, in short, you can say that it's about the ownership, your occupancy, and the proper designation. That's what determines whether property counts as your principal residence.
Thank you so much, Miss Greenish. That was a fantastic breakdown. And now let's just. Sorry, was that anything left you wanted to mention?
No, no, that's it.
Okay, sorry, I just heard something. Okay, so now let's turn to Mr. Jeffrey Ross, our cross-border tax consultant. Jeffrey is a true specialist in US, Canada cross-border taxation with a deep expertise in areas like corporate and personal tax planning. And also crucial CRA and IRS compliance. Jeffrey, does the IRS on the US side approach this similarly, or their perspective is quite different?
Thank you, Ghazal, for that very kind introduction, and I'm really glad to be here with Miss Binish, Farhan, and Faizan. And it's truly an honor for me to be part of this webinar. And hello to everyone, and thank you for joining us today. So it's a great question, and actually, it's pretty similar how things work in Canada, and just there's few notable differences when we look at on the US side. So in the US, the IRS defines your principal residence as home where you live most of the time, and it can be house, condo, or same like in Canada, houseboat. But there must be some features that need to be met, like the place should be the place where you sleep or where you cook or where you bath. And now the IRS doesn't just look at the ownership or your address. They also consider a few more things while determining the principal residence in their scope. So, such as which the property will be your main home. If you are living there, living with your family, with your kids most of the time, your mail is delivered there. The address on your tax return must be that specific home, and the driving license, your license must have that address, the mailing address. Secondly, like if you're looking to avoid paying taxes on profit from selling your home, the IRS generally requires that you have owned and lived in it as your main home for at least 2 out of the last 5 years before the sale. So there's a pretty difference between the USA and Canada. In Canada, if you lived over there for just a year, more than a year, so that will become your principal residence. And obviously, the same things like your return, your everything have that home address on your documents. So on the other hand, in the IRS, if you lived at least 2 years in the last previous 5 years, that will become your principal residence. And when you will sell out that home, you don't need to pay like any capital gain tax on that. I hope this clarifies your question.
That was incredibly clear. Thank you for breaking that down. And let's move on to UK. We have our expert here, Mr. Faizan Rashid, our UK tax expert and director advisory and client solution at Legend Fusion UK. He has several years of experience in tax and accountancy. Faison specializes in taxation, strategic business planning, and financial analysis. So, Faizan, when it comes to principal residence in UK, how it defined for tax purposes, is it similar to US or Canada approach, or is it completely different?
Right, thank you very much. I'm feeling very proud before I jump into in the details, but let me say thank you for having me here with the panel of people from four different jurisdictions. It's really, really good at this time. I'm based in the UK, and on the daily basis, I receive a lot of calls. People talking about we want to rebase to Canada, we want to go to Dubai. What are the implications? And one of the assets they have in UK is their main home, and the question comes to primary residency, how to deal with it in case if they want to sell it, in case if they want to rent it out. And I'm very happy that we come up with this webinar so we can educate the people on this topic. So thank you for bringing this on for all of us. And thank you very much for all of the panelists to be on the board so we can talk and learn about from different countries how will it be treated. So, right, so primary residency. In UK, we call it primary residency relief, private residency relief. It is pretty similar how Ms. Beanish and Jeffrey have explained us. Pretty similar, kind of the same rules in principle. You have to have a main residency where you live most of the time. You have nominated it as your main home, and it is not rented out, and this is the place you live throughout the period. So it is pretty same thing what we heard from America and from Canada. However, we are in UK, so we have our own ways of doing things. So yes, to get it qualified for a primary residency relief, you have to be considered the main home is the property where you live most of the time, as I mentioned earlier. Secondly, that's supposed to be the only home to qualify for that relief. What that means is if you have multiple properties, then you can simply nominate this as your main home. And if you have nominated this, then this property will qualify for private residency relief. Thirdly, for example, if you're not living entirely the period of ownership, but it can be qualified depending on some term and condition, then this relief can be limited to the period when you live there as a primary residency, plus the last 9 months of before you sell that property. So these are the some terms and conditions that SMRC has laid down to be qualified your home as your primary home, and the relief itself is on the capital gain. For example, if you bought a property, you live there, and when you sell it, you have a gain, chargeable gain. And if this gain qualified for the primary residency relief and you take all of the terms I explained, then that means you don't have to pay any capital gain tax. So in summary, yes, they're similar in UK, same like Canada and America. Yes, there's a relief as a granted by HMRC that you don't have to pay as long as it's entirely qualified for that relief. If not entirely, then of course you get a limited relief on it. But this is a great thing, specifically if you are moving out or even if you're considering it to rebase elsewhere. Hopefully that answers your question, Ghazal.
Yes, thank you very much. Very clear and very helpful. Okay, now let's move to UAE. Joining us is Mr. Farhan Osman, Senior Manager, Group Tax at Al Dahra Group. Farhan brings several years of hands-on experience in UAE taxation, international taxation, transfer pricing, and corporate tax planning and advisory as well, helping global businesses stay compliant while keeping their strategic efficient. So, Mr. Farhan, since the UAE doesn't impose personal income tax, how is per principal residence defined there, and does it carry any tax or regulatory significance?
Yeah, yeah, sure. But firstly, thanks for having me here in this very great discussion set on the income taxes for rentals around UK, US, and Canada. It was really interesting to hear from all the panelists, but also a little bit painful to hear how complicated these rules are in those jurisdictions. Though, and but yeah, I mean, talking about UAE, it's quite unique in this context. And in many ways very advantageous because of the simplicity and also the leniency on the tax side, I would say. So yeah, I'm not a real estate agent, or I'm not gonna sell you the dream of Dubai skylines or something. But from tax standpoint, I can mention the fundamental tax principles, mentioning how UAE tax rules are quite investment friendly for real estate investors. See, real estate investment, I think, is a hot cake from investment perspective, yeah. But it can become a hot seat from tax perspective if you're not meeting those complicated rules in those jurisdictions we just heard about from the panelists. But UAE, if we talk about UAE, we have primarily we have two primary tax regimes domestically. Although, and I'm saying primarily because there are some exceptions, some other types of taxes and international tax compliances, but domestically we have VAT effective from January 2018, and then recently we got corporate tax from for the financial year starting from June 2023. So we have mainly or primarily these two taxes in operations. I'm going to talk about both implications from VAT and corporate tax side. And starting from corporate tax side, the key question is whether you are earning this income, rental income, or any proceeds from your real estate investment in individual capacity or in a business capacity. So if it is a personal income, which is the topic for today, if it is personal residential income, then there is, you're right, there is no tax as such. Whether you are generating rental income or whether you are selling your property and getting capital gains, there are no taxes. But if you are doing it in business capacity, then there are definitely there are taxes subject to the thresholds, how much you are generating. But typically you will not earn as in a business capacity if you are, again, if it is your private residence, or if even if you have a couple of residences. The key question is whether or not you are required to have a trade license in UAE to do that activity. If yes, then you have to register for corporate tax, and then would be subject to corporate tax. Talking about VAT, so VAT as a transactional tax, we do have some implications on that side. But again, that depends. Where there are further two questions, whether it's a residential property or it's a commercial property. Since we are talking about residential properties here, they are generally exempt from VAT unless it's your first supply of that residential property. And again, if it is first supply, then it's zero rated. Still, that would mean no VAT charge on the sales, on the first rental income. But the zero rating allows you to recover the VAT you have paid on building that property or buying that property, or in terms of construction and other services. So that's again an advantage for you to have. And yeah, so to your point, it's not following, UAE is not following the principal private residence and stuff like that. It's simple and straightforward, whether or not the activity is personal, or whether the activity is personal or business, and then the next question, whether it's residential property or commercial property. Yeah, that's pretty much it.
I think we all should
Thank
be
you so
moving to
much.
UAE.
Yeah.
That sounds very
Yeah,
excellent
we can add
Yeah,
situation.
value.
again, no, yeah, no
Exactly.
bragging, no intentions. Yeah,
But
just the tax rules.
to do that, first you have to claim the residency relief in Canada, right?
Okay, thank you guys. Thank you, Farhan, for explaining very clear for us. And now let's get into what I know a lot of you are very interested in. Real life situations. We have gone through your submitted questions and picked the top 10 scenarios that came up time and time. We'll put these particular and everyday situation to our experts, and there are chances that one of these situations might be similar to your situation. Okay, our the first common question was just a second. Okay, it was for Miss Beanish. Miss Beanish, what tax implications arises when someone converts their principal residence into rental property in Canada?
Into rental property. So yeah, when you convert your principal residence into a rental property, um, the CRA basically sees it as a change in use. Basically, it is treated as if you have sold your house at a fair market value and then immediately bought it back at the same value. So the scary part is your property has gone up in a price. In case you have bought it, then you create a capital gain. But the principal residence exemption, we do have a principal residence exemption that can help reduce or even eliminate the tax for the years you actually lived there. Um, so now the property is rental, you have declared as a change in use. It is an income producing property for CRA. So same is the case like USA and UK, that now you have to report, first you have to report the rental income. And yes, you're eligible to declare or deduct any eligible expenses like, the typical mortgage interest, property taxes and repairs. And optionally, you can claim a capital cost allowance, depreciation, we call it CCA. But you have to be super cautious because claiming CCA can reduce your future tax exemptions when you sell them. So there is a really good election under subsection 45(2) of the Income Tax Act that basically lets you defer reporting that deemed sale and continue treating the property as your principal residence for even up to 4 years, even while you're renting it out. So that's a really good relaxation, but the key condition is do not claim CCA. So that's why people come to us for the advice, and we mostly advise them not to claim CCA. And eventually, in that case, when you sell the property, your capital gain will be the difference between the time the property's market value at the time of conversion, when you had changed it to the rental property, and the final sale price. And generally, it is 50% of that gain that will be taxable.
Thank you so much, Miss Beanish. Let's take this same situation, but in UK. Faizan, if someone rents out a UK property that was once their main home, how does that affect private residence relief?
Right, a very common scenario, and but not as complicated as Binish explained from Canada. Right, so once you're living in a property, it's your primary residency, and you start doing renting it out. So from the day you move it out to renting out, from that day onward, you're required to have a record of your rental income and expenditure, and every year you have to report your rental income on that property through your self-assessment that normally take place every year in April. So you will be paying income tax on any of the income generated. There are some allowable expenses, but unfortunately, like Canada, we don't really have luxury of claiming the interest in here in the UK. So after Section 24, we cannot really claim interest as an expense. So if you move out and you rent it out, then you're expecting to pay income tax on the rental income generated on that residency, and it will no longer be qualified your primary residency as well. In terms of capital gain, the relief is available, but however, the relief is limited to the period this was your primary residency. For example, let me put into perspective. Let's say you have a home for 10 years. For first 6 years, it was your home where you was living at, and it qualified for a primary residency. And then you sell it after renting it out for, let's say, 4 years. So no, overall, 10-year occupancy period, you can claim a relief on a pro rata basis only for the first 6 years, plus the last 9 months. The last 9 months is just a relief that HMRC is giving you. So 6 year plus 9 months, you can get a primary residency relief. So that means this is a very a big relief for the gains that will be generated over the 10 years. So still the relief is there, but it will be limited to the time period when it is occupied by yourself as your primary home. Another scenario can be there used to be another thing we call it letting relief. So, the law has been changed since 2020 April, but still there are bits and pieces that can be used. Previously, you could have claimed a letting relief as a portion in the capital gain tax for the period you was renting out. However, after 2020 changes, that relief has been almost minimized or been reduced. One of the main term you can have or you can get that letting relief is you have to live with the tenant there. In case if you're doing so, you can claim a letting relief as well. However, these are the changes like you have to pay in the income tax and secondly, your primary private residency relief will be limited to the period when you actually live in the property plus last 9 months.
Thank you very much. And of course, we cannot leave out USA from this scenario. So, Jeffrey, a question for you now. Could you walk us through the capital gain tax rules if a primary residence in the USA is first converted into the rental property before it's sold?
Yeah, absolutely. This is a great question and most common scenario in the US as well. People normally do they rent out the property when they have one more property, so they change their principal residence from one to another. So, but in the IRS in the USA, IRS consider it little differently. Like Faizan said and Binish said that like the time period they resided in that property would be considered for the period as a principal residence. So they are exempt for that. Later on, Miss Binish said that the change in use, Faizan said differently, but they are quite little bit similarity. There is in but in the US again I will say there is like 2 out of 5 years rule will apply. So in the US, the IRS gives the nice tax break, like on the sale of your primary residence called the Section 121 exclusion. If you have owned the home for at least 2 years, the same thing out of 5 years, so that will remain your principal residence. The IRS says that if you sell the property within this time period or within the 2 years time frame, so there is $250,000. This is not completely exempt like in UK or in Canada, but there is a limit or you can say the threshold up to $250,000. And in case if you are single, you are sole owner, and if you are if both you and your spouse own the property, then there is $500,000 the threshold you can claim as an exemption for capital gains taxes. So the other thing, once you moved out, the main thing, like once you moved out and start renting, the 2 out of 5 years clock keeps running. As long as you sell within that 5 years window, you can still claim the exclusion for the portion of the gain tied to your personal use period. However, you can gain any gain that comes from the depreciation. There is one different thing you can claim while it was a rental is not excluded. So you cannot um, because once you rent out the property, you also claim the depreciation on that, and that depreciation amount will be added back to the sale amount, and you have to pay tax on that amount other than the 2 years exemption or up to or the threshold that I mentioned earlier. I hope this clarifies the question.
Thank you so much, Jeffrey. It's very much clear. And now let's move to UAE. Faham, what happens when someone decides to rent out their principal residence there? Are there any tax implications or sorry, compliance required?
Yeah, so again, as we have established earlier, there's no personal income tax or capital gain tax on individuals if you're doing it in personal capacity and not in a business capacity. But that being said, still it's not like you're buying bread from a shop. So there are, of course, regulatory steps, such as registering with the regulatory authorities in Dubai or Abu Dhabi or wherever you are, renting this property out, such as in Dubai, you've got Ijari or contract, or in Abu Dhabi, you've got Tosik or Totik. There are different pronunciations. So yeah, well, these regulations are involved, not tax, but there are regulatory steps, and there are also some other charges which you would not fundamentally define as tax, but there are some small charges on renting or on transfer of properties.
Thank you so much. Okay, great insights there. And let's zoom in a little bit. And instead of renting out the whole property, let's consider if they are just renting out a part of it. Miss Binish, in Canada, what are the tax implications if someone rents out just a portion of their principal residence, like a basement suite or a single room?
Yeah, this is very common, especially in our Desi community. We mostly rent out a part of our portion of our building. And if you're renting out just a part of your principal residence, like a basement, or even sometimes people rent out a single room, the CRA looks at whether the portion had a change in use. Normally, converting a full property to a rental triggers a deemed sale at fair market value, as I had mentioned before, and that actually can lead to capital gains later, as I mentioned. But the good news is, if you meet few three simple conditions, like you can still treat your whole property as your principal residence. First of all, the rental place has to be smaller compared to the entire home. So you just see the substance over form. And then you haven't made any major structural changes to create a self-contained unit. No major refurbishment. And thirdly, you're still living in the home as your main residence. If all of these conditions are met, there is no deemed sale. And the good news is your principal residence exemption stays intact. But you still need to report the rental income, and you can claim a portion of expenses, like I had mentioned that the utilities, property tax, mortgage interest, etc., based on the rented area. But while calculating that, you need to be extra careful again while claiming the capital cost allowance. So capital cost allowance, if you go for the claiming that thing, you can definitely reduce your tax exemption later when you sell. So in short, um, renting out part of your home is fine, but just stay with the CRS conditions and skip the CCA, the capital cost allowance, to keep things simple and tax efficient.
Many thanks for that. And Faizan, what about UK? How is it taxed if only a part of main home, say a spare room, is rented out to a tenant? How would that work?
Right. The HMRC is quite generous in that, I must say that. Not like Canada, but they have introduced something called rent a room scheme. What it is, it allows the main homeowner to rent a room or a part of their property at and they don't have to pay a tax if the earning from that uh, portion is up to a £7,500 per year. So, for example, if you fully own the property, 100% ownership is yours one, then you can claim in your self-assessment up to 7,500, a tax-free rent-a-room scheme. You can declare it to HMRC. Declaration is mandatory. However, this 7,200, you don't have to pay taxes on it. But remember, this 7,500 is the gross amount, the rent you receive. You're not allowed to reduce any expenses out of it. In a scenario, let's assume your rent is gone above 7,500. Simply, you can choose one of the two options. Option number one, you simply pay the standard tax on anything in excess of 7,500, and you're not supposed to claim any expenses. So this is option one. Option number two, is you simply declare your rental accounts with HMRC. Uh, if you want to claim your genuine expenses, then simply you cannot claim a relief of 7,500. You just declare your net profit of renting that portion and pay the income tax accordingly. So this is how the government is supporting because they have to come out this houses crisis thing. And let's see for how long they will be supporting. This is a very good way of making extra money if you have a spare room in your home. So this was the scenario when you're renting out. And the good thing is, this does not affect your position in relation to primary residency relief when you sell the home. So that means if you sell the home, then you're fully entitled for 100% relief as long as over the period that is your main home and you still can rent it out a portion. So that's a good one from HMRC. Yeah.
HMRC is nice, at least in some ways.
Yeah.
Yeah, I would say the HMRC is also generous.
uh,
For a change.
Okay, Jeffrey, it's your turn now. How does US treat situation like this when part of a primary residence, such as a basement or a single room, is rented out?
Yeah, it's again a very common scenario in the US as well. I would say, like in Canada, if you rent out like 30-40%, you are again free from paying capital gain tax because that would be considered the less than. So the CRA gives the margin. And on the other side, as Fazan said, that there is a scheme to rent out a room, and I would say the HMRC is also generous, but IRS is really strict on that. So the IRS says that either you are renting out the part of your property, obviously like the HMRC, you don't need to pay taxes, or there is some exemption on that. But on the US side, you have to pay rental income tax. You have to include that rental amount in your tax return, on your regular tax return. You can also claim expenses to the relevant portion. Like suppose if your the home is around 1,000 or 2,000 square feet, and you rent it out like 30% of that or 25% of that. So you have to prorate your expenses as well according to that, the area of the property you rented out. So you have to prorate the expenses. You can claim them against your the rental portion of your home. And secondly, IRS says that you cannot claim the exemption regarding that I've earlier mentioned earlier, sorry, the section 121 exclusion. So you cannot claim that section to the specific portion you rented it out during that portion. Now it's again now I mentioned that like if you lived in that home 2 out of last 5 years, the portion you kept with yourself for your residency, for your main residency, that will we can apply that section onto that. But for the rental portion, we that you cannot apply that section again, because once you rented it out, the portion of your home, you cannot apply that section one to one to exempt the capital gains tax. So you have to, when you will sell the property, you would have to pay the capital gain tax on their specific portion, and you also have to pay tax on the principal residence. And one more thing which is really like crucial, or you can say the cruelty on the IRS side, that either you claim the depreciation or on that specific part, or even you don't claim the depreciation, you also have to pay the capital gains tax on the principal as well. So I would say, Faizan and Binish, that on your side, in your jurisdictions, it's easy and there's much relaxation. But on the IRS, on the US side, IRS is very cruel on that. Thank you.
Thank you so much. Okay, perfect. Let's shift the focus on non-residents now. That's something we were asked a lot. Vinish, how is rental income tax for a non-resident who owns a property in Canada?
So we have many people who have took the citizenship and they have moved out to UAE or other countries, but they still have their property. So we call them non-resident. If you're a non-resident and you own a rental property in Canada, The CRA basically simplifies things for itself because it takes the 25% of your gross rent, meaning the total rent before any expenses. It is withheld and sent to CRA straight away. Before even you enjoy that rent, the CRA already has taken its share. So this withholding is usually done by your tenant because you're not there, or your property manager, and it is mandatory. That 25%, that's definitely going to affect your cash flows. So that 25% does not have to be your final tax. It's just, safer side on part of the CRA. So you actually have two main options. How can we make it better for our cash flows? Option one, you can accept that 25% withholding as your final tax. Nobody would like to do that. And in that case, you don't have to file a Canadian tax return, but also you cannot claim any taxes. And option two is you can file a Section 216 tax return, which basically allows you to report your net rental income. That is after deducting things like, again, the mortgage interest, property tax, insurance, etc. And this usually means you will pay less tax. And if too much was withheld, let's suppose that 25% was definitely more than you expected to as your net rental income, then you can even get a refund. If you would rather not have, again, the problem is by the time you have calculated these taxes, your money is with CRA. So if you really want to avoid that 25% withholding of your gross rent every month, what you can do is you can file Form NR6, the non-resident, with the CRA. This basically allows you to estimate your net income in advance. So the withholding is based on that lower amount. That improves your cash flows for sure. And just remember that filing NR6 means, it does not mean that you don't need to file Section 216 tax return at the year end. They both are equally important. In short, so the non-residents are taxed on Canadian rental income, but with the Section 216 return and NR6 election, you can often reduce what you owe and manage your cash flows better.
Thank you very much, Binish. Faizan, how about UK? How are non-resident landlords taxed on UK rental income under the non-resident landlord scheme?
Right. Okay. So non-UK landlord, your tax resident are very important to our economy in here. We have a lot of people, they have invested in UK, but they're not living in here. So they have a major contribution to the UK economy. And also, there's a misconception about these NRLs that they pay an extra tax. That's not true. Pretty similar what Binish explained in Canada. Uh, if you're a non-resident and you hold a rental property in UK, your tenant or your state agent will withhold 20%, not 25%, better than Canada, I must say that. They have to withhold 20% of the gross rental income. And then they have to pay directly this income on the monthly basis to HMRC. And this is again the holding tax. It's not your final tax position. In simply any NRL, they have to non UK tax resident landlord. They have to register themselves through a scheme called NRLS. So they will be taxed according to that scheme, the way I explained, through a holding tax. However, of course, this will be affecting the cash flow. Uh, and again, HMRC come up with a generation here. So they are very generous on this time as well. So you can come out of this scheme by filing NRL1 form. If you are accepted by HMRC and your form NRL1 has been accepted, that means you don't have to pay, or your tenant don't have to pay holding tax to HMRC on monthly basis. They will pay you in full as a gross, and at the end of the year in April, then you will file your rental account and through a self-assessment and report your income after detecting all of the expenditure and will paying the genuine taxes, whatever you owe to HMRC. However, in case of holding taxes, still you're required to file a final tax return. And in that case, if you have paid over, that can be refunded. And if you have paid under, then you have to top it up. So simply, this scheme is there to support the HMRC to make sure they collect the right amount of the taxes in proper way or in proper time. It's not an extra tax. It's the same like everyone else pays in the UK, but they have to hold it because they believe the people who are not in UK resident, maybe they don't pay the taxes or something like that. But there's an option to come out of it as well.
Thank you so much, Faizan. Okay, over to US now. Jeffrey, how is rental income tax for non-resident alien who owns a property in this state?
Thanks, Will. This is a common and important question for many non-resident investors in the US. So, when a non-resident alien owns rental property in the US, the rental income is considered US source income and is subject to US tax rules. It's similar like in UK or in Canada, like they have a property manager, the agent who look after the property. They withhold the taxes and remit the to the relevant tax authorities like HMRC, CRA, or IRS. So it's a pretty similar situation on the US side as well. So you could say that the IRS requires a flat 30% withholding tax on the gross rental income paid to the non which is normally paid to the non-resident aliens who own the property. So this means the payer, usually the tenant basically, or the property manager, they must withhold 30% of the gross amount, and they have to remit it to the IRS. However, non-resident aliens have the options to make a special election. Like in Canada, I would say that there is an option to submit NR6 form, and you can file an election, and then after that you can submit it under Section 216. So a kind of same thing over here on the US side. IRS says that if you can also make an election under Section 871D of the Internal Revenue Code, and by making this election, they agree to treat the rental activity as effectively connected with the US trade or business. So in this situation, this basically benefit the non-resident owner of that property, and he can submit the 1040 NR, the non-resident tax return. And he can also report the expenses of the property against the gross rental income. That would help him to lower down the gross from the gross rental income to net rental income basically, and it would eventually help him or her to lower down the taxes basically by like choosing the election 871D. So this election also lets them deduct, like I mentioned earlier, like he can deduct like property tax he paid, or repair maintenance, insurance, management fee. So these types of expenses will help him to reduce the gross rental income to the net rental income. Okay, so when we come up to like when the non-resident alien of the US, when they sell the property, so there is another factor comes up, like they have to pay 15% of the sale amount to the IRS. Uh, like the buyer would be liable to deduct that amount, withhold that amount, 15% sales amount, and he needs to remit that amount to the IRS. And later on, once they clarify everything, and then the seller, the non-resident seller, will submit the return, and then he would be able to recover the amount. Like it could be 15% or more amount, but later on, the reason is same in Canada or in USA, because the both tax authorities, they want to make sure that the non-resident is basically he's not living in that country, so they need to make sure that they are doing the compliance of the law, the tax law. So that's why they have to do that. I hope this clarifies the question. Thank you.
Thank you so much, Jeffrey. Yes, very much clear. And let's wrap up with a question that trips up many landlords: depreciation. Binish, what are the tax consequences in Canada when claiming depreciation or capital cost allowance on a rental property?
The capital cost allowance, it can be a bit confusing, but it's really important to understand. When you claim CCA, you are basically spreading the cost of your building over several years to reduce your taxable rental income. That is just an explanation for a layman. So it's a great way to lower your taxes in the short term, but it has its own implications. The catch is when you sell the property, the CRA may recapture that CCA, and that means if you sell for more than the remaining depreciated value of the building, the amount you previously claimed as CCA gets added back to your income and taxed at your regular rate. If you sell for less than that value, you might get a terminal loss that is favorable and which can help reduce your taxable income instead. So, I would advise a few quick reminders to be kept in mind is number one, claiming CCA is optional. You don't have to claim it every year. And you can claim it on a building, but not on land. And most rental buildings, they fall under class one or three for CCA purposes. So overall, CCA can be a smart tax planning, but it has to be a balancing act. It does help you reduce your taxes now, but you could pay more later when you sell it. So it's always a good idea to get advice before you decide how much to claim.
Thank you so much, Binish. Okay, let's take a look at how things work for non-resident in UAE. Farhan, if someone lives overseas but owns a property there and earns rental income from it, how is that treated for tax perspective?
Yeah, sure. So yeah, again, I couldn't help but smile when Jeffrey mentioned to Faizan and Benish that how CRA is or HMRC is generous or simply simple in terms of taxing. Or not just me, but maybe with the Federal Tax Authority in UAE is also smiling on this comment because I guess that in UAE, the Federal Tax Authority can undoubtedly win this race of simplification and leniency on the taxation side. I still remember back in 2010 when I started my tax career with a UK-based tax firm. My biggest portfolio of client was the non-resident landlords. And I remember that they couldn't file their returns directly to HMRC and they had to use third-party software to prepare their returns. And Fazan, maybe you can confirm. I guess it's still the same after 15 years that they do have to use those third-party software to pay extra and submit their returns. Um, and I guess same goes to US as well. Like the way their tax are designed is kind of, I call it clawback kind of tax regime where if you are, I don't know if it's you're lucky or unlucky, but if you are a US citizen, wherever you go, the tax would follow you. And yeah, that's the case basically. If you are in UAE, you don't have taxes, right? If you would be treated as residents are treated, even though if you are non-residents, again, depending on the conditions I mentioned previously, it's if it's individual income, if it's residential income. Normally, non-resident would or can do it for commercial reasons as well. For example, holiday lettings and stuff like that. So if it's that, you may have VAT implications on that, but otherwise it's the same thing. No taxes on income or proceeds. Yeah, unless you are a U.S. citizen, maybe then you will have taxes in U.S. Not again, not in UAE.
Thank you so much, Farhan. Okay, same idea, but for UK. Faizan, what are the implications of claiming capital allowance or guarantee relief on a UK rental? Fear. Sorry, Faizan, you're mute.
Oh, apology, guys. Right. Before I jump on, let me get back to the Farhan's comment about taxation. He's very right to say, for example, if I'm a UK tax resident and I have a property in UAE and I'm making some rental income there, so and I enjoy the luxury of not paying taxes in UAE, but as a UK tax resident, I still have to file a tax return and pay the rental income tax in here. Don't like it, but unfortunately, this is what it is. What we can do. Yeah, enjoy the luxury there. Have fun. Yeah. Okay. So coming back to the question, you asked for the capital allowance and depreciation. Oh, okay. All right. Okay, in UK, there are no depreciation to be allowed to be claimed on your rental income. So there is no depreciation on the building, unlike Canada and America. I think Jeff is going to explain that as well. So there's no depreciation on rental income, so we cannot use that, unfortunately. And also, it's in a good way, when you sell the property, it will help you there as well. However, there used to be an allowance, we call it wear and tear allowance. Again, the UK government has abolished it back in 2016, so there's no flat rate allowance available for any furnished or unfurnished property. However, again, you can claim something that you have generally spent on the rental profit. For example, if you're having a state agent and you're paying a commission to him, that's a genuine expense. You can claim it for your rent from your rental profit. You have done some maintenance work. Let's say you have a regular insurance coming out of your account for that specific property, of if you're fixing something, doing a kind of refurbishment, then this can be claimed through your rental income and can reduce your profit. But however, there's no depreciation, no capital allowance on the property or building itself. When we talk about capital allowance, there might be something available on some of the qualifying assets. For example, if you have a new boiler installed, or maybe if you have let's say the plates for the solar system installed. So these equipment can be claim allowance over the period or life of the asset. However, when you sell the property, the good thing is you don't have to recapture it, so you don't have to add back and to pay the taxes. So that's a relief that is available there. So that's a good thing. And one more thing, that's a verse in UK, that's a section 24. Because of section 24, you cannot claim even your interest as an expense for your rental profit, and that's a shame. So these are the things that you can do.
Exactly.
So only thing to mitigate your income is just to make sure you have the proper record of all of your actual expenditure, and you can claim all of those through your self-assessment. Yes.
Thank you so much. And Jeffrey, what happens in the US when landlord claims depreciation on rental property?
Yeah, on the US side, I would say that it's again, they don't give any relaxation or relief on the US side. Either you claim the depreciation or you don't claim. They consider it like that you already have claimed it. So IRS basically like has a rule they call like depreciation recapture that you need to be aware. Normally, what happens when we tell the taxpayers or the people of the US or even the non-resident owner of the property, when they get to know that they are paying the capital gain tax on the depreciation amount, they have to edit that amount back. Even they didn't claim that on the prior returns when they own the property, so they get upset on that. So it's pretty you can say that the IRS has a very strict rule and they don't let you go by any way that you have. They get the tax from all the ways that they want. So on the US side, I would say yes. Either you claim the depreciation on the property or you don't claim it. But we normally suggest all our clients to claim the depreciation because there is no relief on that. So if someone is missing the depreciation on the return, we ask them to provide us the cost basis of the property so that we can claim the depreciation. We can make that net rental income to zero, so they don't so they don't say so they don't need to pay any taxes at that time when they're filing the taxes or filling the schedule E in the tax return. So on the other hand, when they sell the property, they have to add that amount back to the sale amount, the depreciation amount, and they have to pay taxes. So in short, depreciation is valuable reduction while you own the property, but it has a tax cost when you sell. So it's important to be prepared that the factor it into your long-term rental property strategy. Otherwise, you will end it up like with chaos that you didn't get it at the last time, at the last minute. You got frustrated, and then you would start calling to your previous accountant. It happens normally. So the client would get frustrated because their previous accountant didn't inform them, because they didn't claim the depreciation. So in that case, we have to amend the returns for the prior years. Thank you.
Thank you so much, everyone. Okay, that wraps up our Q&A segment. A huge sincere thank you to everybody who sent their questions, and we truly hope that you're leaving here with much more clarity about your tax situation across Canada, US, UK, and UAE. Binish, Jeffrey, Faizan, Farhan, a massive thank you to each of you for explaining things so clear today. It's one thing to read these complex tax rules online, and it's completely another thing to hear them from an expert. Your insights are invaluable. Thank you so much. To everyone who joins us today live, we know taxes are not always the most exciting topic, but when it comes to living or working across borders, getting this stuff right can save you a lot of hassle down the line. We truly appreciate you being here and engaging with your excellent questions. And we are excited to announce that we'll be conducting these live webinars on a monthly basis. Our goal is to keep impairing knowledge and helping you take care of and take control of your finances. If you still need help with your specific situation, or please do not hesitate to reach out to us. We will be sharing a link for today's recording and some additional resources and some details to how get in touch with our experts for one-to-one consultation sessions. And thank you so much for joining again. We hope to see you again in next webinars, and take care and goodbye.